Well, good afternoon, everybody. Welcome to our latest investment panel debate. For those of you who don't know me, my name is Mike Deverill, and I am partner and investment manager here at Equilibrium. And today we are going to be discussing investing in the post-COVID world. You know, what investment trends are we seeing at the moment, whether that's long-term or short-term trends, and how have those trends been affected by the pandemic? And how do we know whether any of the changes we've seen are temporary and will just go back to what they were before once the pandemic finally goes away, and what represents a permanent shift? And then how will all those changes and trends affect various different asset classes, whether that be listed equities or what we call real assets like infrastructure or property? And to help me discuss all that, I'm delighted to be joined by two absolute experts in their fields. Firstly, I'm joined by Gervase Williams, who is Head of Equities at Premier Miton. If you've joined any of our events before, you'll know, you may have seen Gervase before, and you'll know he's always great value, always goes down well at these events. So welcome back, Gervase.
Thank you.
Gervase is one of the sort of foremost investors in UK equities in my eyes, particularly as a smaller company specialist. So it's great to have him on. And joining us as well will be Nick Scullion from Foresight Capital Management, and he is making his Equilibrium debut, shall we say. So welcome, Nick. Thank you for joining us. I think Foresight's a really interesting company because they specialize in lots of things, but mainly things like infrastructure investing, which is an asset class we find particularly interesting at the moment. So it'd be really interesting to hear what Nick's got to say. Nick's also the co-manager on Foresight's Sustainable Real Estate Fund, so can touch on property as well. So, you know, thank you both for joining us. Obviously, I know everyone's very busy at the moment, so it's great that you're giving up your time. For this afternoon, we've got 45 minutes, and during that 45 minutes, I want to cover kind of 5 key topics. So it's going to be pretty fast-paced. So the areas that I want to discuss are as follows. Number 1, technology and the consumer. We'll look at how the pandemic has accelerated the shift to online shopping and discuss again whether that's going to be a permanent shift or temporary. And related to that, the second topic will be the future of work. Will we all be working from home at least part of the time going forward, and what implications will that have for companies and offices, etc.? And then thirdly, a big one obviously is climate change. Now, the government has promised we're going to build back greener after the pandemic. So we'll look at climate change and we'll look at those promises and those policies to address it and see how that might affect investment markets. And then one of the hot topics of the conversation at the moment, certainly in the financial world, is inflation. We are seeing higher inflation as we come out of the pandemic. Is that a temporary blip, or is it back for good? And how will central banks react? And then finally, more of a long-term trend is an aging population, as we have here in Britain, we have in many developed countries. What effect will that have on future economic growth? And has the pandemic exposed a bit of a weakness, perhaps, in our health and social care system? So those are kind of the main areas we're going to discuss, but we also want to hear from you at home. So if you do want to submit a question at any time, please hit the Q&A button on your screens and we will answer as many as we can at the end. I'm going to be joined by my colleague Ben Rogers at the end, and he will help me to go through all those questions and we'll answer as many as we can. So quite a lot to get through. We only got roughly 8 minutes per topic. So Gervase and Nick, I'll ask you to sort of keep your answers to maybe 3 or 4 minutes maximum, please, on each side, in each time. So first topic, technology and the consumer. So before the pandemic, it was somewhere in the region of 20% of retail sales were made online here in the UK. During the sort of depths of the lockdown, that climbed to maybe 36, 37%. It's gone back down a little bit. But what I want to discuss is whether we think that's a permanent shift, or do we think we'll go back to pre-COVID trends when the economy is reopened? So Gervase, I'll start with you to begin with, if that's okay. You know, have you got any thoughts on this, and how is it affecting how you construct your UK equity portfolios?
Yeah, I mean, coming back to your question, Mike, I mean, the issue is really that we've seen a massive change. It was already a gradual change, but the change has greatly accelerated over the COVID crisis, and we've all got quite used to doing normal things, which we used to do in shops, sort of online, and we've become quite good at it. So in that regard, it is a permanent change. But actually, what's interesting was when I talk to companies, they're not just talking about the technology online, and many of the existing suppliers have had to move online over the last sort of 12 months or 18 months as well. But what they're also saying is that actually quite a lot of businesses which are already online are beginning to move back into the terrestrial world. And that's not just little companies, which obviously I invested, but things like Amazon in the UK have now got Amazon Fresh, where you go in and you don't have the same scanning on the way out. And so actually the hybrid model, including both online and offline, is becoming quite a viable option, and in a way is a better option, because quite a lot of us want to move into shops. We want to look at things. We don't just want to do it online, even though it can be advantageous at times. So I think there's a real mixed message going forward in terms of, I don't think it'll just be online. I think online will still continue to take more market share going forward after a dip maybe, but most particularly I think terrestrial will continue to be an important way, not just in terms of demonstrating you've got product locally, but also branding and connecting to the local communities, and localism's going to be quite a big thing going forward. So I think that's the first thing. The second thing I would say is the wonderful thing about being online is that when you put things online, you get answers really quickly. Because people are always surfing around all sorts of things, as soon as you put something online and maybe a message or a new product or whatever, literally within a couple of hours, if it's going to be popular or not. And so from that point of view, it's made it easier for businesses to be much more responsive to the customer. And I think that pattern, which has then taken a giant step forward in the last sort of 18 months, I think will also be there going forward. So I think you'll find that corporates generally, not just retailers and consumers, are going to be much more responsive to customers' change. And I think customers are changing a lot. I think there's going to be not just ESG, social governance issues, to do the environment and stuff. I think there'll be other reasons for people to choose their suppliers more carefully going forward. And I think that will give them a good opportunity. So it's a really interesting development. Plenty to go for. But it's going to be a mixed culture going forward, I think.
Well, I think that's really interesting, especially, what you talk about the sort of hybrid approach, because I think when people talk about technology, they think the way to play this in a portfolio is to buy some tech stocks, to buy your FANGs, as we call them, your Facebooks and Amazons, etc. But surely every company has to be a tech company now. Everybody's got to be tech enabled. They just won't survive. So is that the way to play it? Look for the best sort of, the companies that are using the technology, or is it the people who own the technology?
That's absolutely right. I mean, you have technology portfolios and you have technology sectors, but as you say, bottom line is every business is a technology business now. Even things which you might call relatively routine businesses actually have to be very sophisticated in their technology, and they all need engineers and such like. And one of the features which has been interesting is that with the changes of Brexit and COVID and people going home and all the rest of it, it's become really quite difficult to get some of these staff actually. And I was talking to a business which sells cars this morning, and I was talking about staffing, and they were saying, well, we can get some staff here and there. They said the number one area they're holding them back at the moment is getting technology staff. And you just think, well, there we are. That's a car business, right? That's a sale business. So it affects everyone.
Yeah, absolutely. Well, Nick, coming over to you, obviously, you invest in a different type of assets, as we were saying, what we call real assets, physical assets in a way, buildings, infrastructure. But if we're shopping online, rather than in shops, and clearly that has an impact on those markets as well. We don't want to own a high street real retailer at the moment, do we? So how does that affect some of those markets that you look at?
No, absolutely. And I think when we talk about consumer behavior, what's really interesting to think about is the supply chain impact. So there's been a real focus on logistics that we've seen in the last 12 to 18 months. And consumer behavior online requires a completely different physical blueprint behind the scenes to get products to individuals. So we've seen a rise of the supersized warehouse and distribution centers. That enables a completely different investment proposition, where you see tenants like Amazon signing long-term, multi-decade contracts with inflation protection on these types of facilities. It's a really interesting way to play this theme, I think, from a real assets perspective. We like to invest in listed businesses that own physical real assets. I think there's also clearly a difference, the delivery network. So digitization is going to be a major theme. If people are doing all of their shopping and society is acting online in a much more prevalent way, that requires massive investment in digital infrastructure. So you see the data centers that are required to process that data. and to enable that shopping, and that provides infrastructure investments for us.
That's really interesting. And also just picking up on that, and also something that Gervase said, you talked about hybrid, the kind of hybrid approach in retail in particular. Now, how do companies address that, or how do you address that as a sort of property and infrastructure investor? And I'm thinking about things like supermarkets, for example. The right investments, those that can both reach people online and physically in store.
From our perspective, we think that supermarkets is a really interesting asset class within property at the moment. The way that we're trying to play the property theme at present is resilient sectors. We think that warehouses, logistics, supermarkets in particular, they still have a massive role to play in society, and consumer behavior will continue to visit these facilities. Many people are not doing all of their online shopping all of their food shopping online at present. They still want to go and see what they're buying.
Yeah, absolutely. I can really see that kind of having a real big effect. But from the sort of real assets point of view, there's other areas you avoid. I mean, I suggested whether retail, a high street retailer, but actually, people can take the opposite view. Maybe this is exactly the right time to be buying stuff like that. Take the value approach where values are depressed. So, I guess, do you see that, any value in retail at all, or is it just too risky?
I think the threat is clearly to old school retail. The shopping centres, malls, I think they are very much fading as a method of consumer behaviour. I think to Gervase's point earlier, this is a trend that is not going away. Whilst there may be a hybrid model, old school retail, I think, is going to be a very difficult theme to play. Whilst, of course, there will be volatility in the sector, which can be an opportunity for investors with high conviction. We are much more long-term in our view, and we think that avoiding the retail sector is probably the right way to play the theme from a security perspective.
Okay, interesting. Well, I think what I'll do, I'll move on to our sort of second topic because it's very linked to the first one anyway, which is the future of work. So because technology, again, has been the savior really of companies during the pandemic. We can't, if we didn't have Zoom, Teams, all the like, then it would have been a very, very different experience for a lot of people. And most businesses, including Equilibrium, have announced, or many businesses anyway, that they'll continue some element of working from home, flexible working, even when the pandemic is over. So again, Nick, I'll come back to you first this time. What does that mean for the things that you look at? So I'm thinking, offices, and I'm thinking, the more infrastructure investors like transport. If we're all, sat at our computer screens and not actually going to physical meetings quite as much, what does that mean for you?
No, absolutely. It has a big impact across major infrastructure sectors, across transport networks, both international and local, offices, of course, and just the physical footprint of where people are working, but also on energy networks. So how are you getting the energy to the places in the community that it's being used, and how is that being distributed? I think one point that I would like to make is that I personally think that the remote working long-term future is somewhat overstated at present. I think that if people are saying that they're expecting to work 5 days a week across all industries from home from now on forever, I think that's probably unlikely. I think that it's more likely to be 3 or 4 days in the office rather than 5 days at home. Microsoft actually did some really interesting analysis of usage of Microsoft Teams throughout the last 18 months. And what they found was at the beginning of the pandemic, people were very good at reaching out to other teams within their business and collaborating with different people. But as we've gone through the cycle of the pandemic, people have retrenched to their silos, and that's a real problem for innovation, because innovation tends to happen at the intersection of different teams, where people with different perspectives come across one another and germinate ideas. And as new people join organizations and fewer people are known to each other, the interaction point is going to become much harder. So I think we will still see a very real place in the office for people. So
the office itself as a building still has a place to play in a property portfolio then?
I certainly think that the office, there is value in learning by observation. There is value to people, mental health, by being around people. We're still certainly cautious on offices from a property perspective, given that the short-term trend is very unpredictable, and we like predictability. That's why we're real asset investors. But we think that long-term offices are not going away. People have predicted the end of the office before, and I don't think this time is going to be it either. Yeah,
I think, I tend to agree. I think it's very, very, there's certain things that, much harder to do remotely than there are face-to-face. Other things work pretty well. So To me, I think the flexible approach, almost as we talked about with in retail, the sort of hybrid approach may be the way we end up. So, Gervase, I'll come to you. Have you got any thoughts when you start talking to individual companies? What's the typical trend of what they're all doing about flexible working, etc.?
Yeah, I mean, clearly, like service businesses particularly find it quite easy to move into flexible. It's not a walk in the park, but they've all managed to do it over the last 18 months, and it's been in a way an interesting feature that, because people haven't been going out or going on holiday, if anything, operational efficiency has actually improved in the period, which is probably something which was unexpected. And most particularly, I would definitely echo Nick's point about if you're not in the office for 5 days in a week after a few months. Then, of course, to what degree are you not going to be replaced by a Romanian worker or something who also isn't in the office for 5 days a week? So this is a dangerous pattern to go down. You need to continue to keep relationships, and relationships are about everything is about one-to-one relationships. And if you're online, you do get some one-to-one relationships, but you miss many of those coffee discussions over coffee and things. Coming back to the point about businesses, what's been quite interesting as a fund manager is I wondered whether we would be as good as making decisions across Zoom. You quite like sort of meeting people, you sort of see how they react and such like, and you can see a little bit over Zoom, but do you get as much information? And what I've been pleasantly surprised about is one that actually we've been continuing to make good decisions as far as we're concerned. It's been good enough. But one of the features which has been unexpected benefit, of course, is that actually we can get hold of executives quicker. They're not always on aeroplanes. They're not always out of the office. They're actually, in many cases, available and indeed have less busy diaries in terms of, they're more available. So actually, we can actually speak to people more often. We get more one-to-one opportunities. We can therefore keep closer to our businesses and hopefully make improved decisions as a result of that. So if anything, I've seen it actually as a big benefit.
That's really interesting. I think we would echo that as well. Speaking to people like yourselves, we're having probably more meetings than we've ever done, seeing more fund managers than we ever have done before, simply because you can fit more in the diary. You haven't got traveling time. The fund managers don't have to come to you. But just one thing that I was thinking, I think it's quite an interesting point is, if we are, let's say that flexible working does become the norm, or partially the norm, then that has a financial benefit in many ways. But I wonder who ends up with that benefit. So if somebody, for example, is currently paying a huge London rent and has to travel to work for an hour a day, now it's a clear benefit to them spending some time at home. Perhaps they can save money on the transport costs. Perhaps they can actually live outside of London, say, and pay less for their housing. So that would be a financial benefit. But then I also then wonder, will companies not just adjust to that, and they may not have to pay London waitings anymore? So is that, at the end of the day, who gets that benefit? Is it the individual, or is it the company?
I mean, I think it's going to be a mix. It's a cop out, really, but most particularly, I think that companies are going to have to work a lot harder to get people in the office, not just because they're traveling and people don't like traveling and being worried about COVID and all that kind of thing, but most specifically, actually, because when you go in the office, you want people to kind of want to come back. So they're going to have to work a little harder. We're going to have to work a little harder, having better coffee machines and all the rest of it. So there will be extra costs as well as extra benefits to it. So I do think it's going to be quite a dynamic, and most particularly, we've got bigger dynamics such as the end of the COVID crisis and changes in the stock market trends to worry about as well. So I think when we look back 5 years' time, I think we'll find it hard to determine who's had the benefit. Everyone will have some parts of that benefit, but I think it'll be very much hard to work out who got the best of it.
So will it be the solution to perhaps the productivity problem that we've had over the last few years, perhaps?
Yeah, productivity. I mean, it's interesting. Everyone just says how unproductive we are compared with the Europeans, for example. And in fact, once you look at the data, it's much easier to measure productivity when you're talking about cars or physical things. It's quite hard to measure productivity in terms of services. And actually, the UK has a very small manufacturing base compared with Germany and France. And on that basis, actually, once you adjust for that, you find that actually UK productivity is just as good as anyone else already.
I think that's probably fair. So just finishing off on that point, then, Nick, coming back to you, perhaps, if we talked about, that the office is still clearly a place for the office, but is this a point where you do have to be careful with your office investments? As I said, perhaps it may be different in a big city like London than it might be somewhere else.
Definitely, I'm not predicting the end of the big city or the end of the office, but I think that what we are seeing as a trend is that big corporations with a big office footprint are looking to rationalize. Now, in many cases, some of that was already in train, and it's just been accelerated in the last 18 months. I think that companies will have to be careful not to slim too much. To Jason's point, it will be difficult to get people into the office if they have to hot desk and they don't have somewhere where they can call their own and they don't have the amenities of home.
Yeah, very interesting. Okay, let's move on to our third topic, which is we call it Build Back Greener, because this is one area the government has promised that we're going to build back greener after the pandemic. We're going to address the long-term challenge that is climate change through investments in the green economy. So, I think one of the questions is that actually happening? Do we see that happening? And if so, how are we going to pay for it? How will we pay for such spending? Will we see higher taxes, further spending cuts perhaps, or can we actually, will it pay for itself through additional growth? So Nick, again, I'll come to you first, if that's okay, because, I say infrastructure, a big part of what you guys do, and you've got big holdings in green energy in particular. So does this bring opportunities, and are you actually seeing any of this promised spending actually coming through?
Yes, great. I mean, our investment thesis relies upon this being an absolute imperative. We need to see governments, especially the UK government, investing extremely heavily in green infrastructure if we have any chance of achieving carbon net neutrality by 2050. That's just a fact. If we need to have only electric vehicles on the roads within a decade, that requires a massive infrastructure investment, which requires a huge shift from everything through energy networks all the way through to how we buy and sell commodities. There's going to be a huge amount of copper that's required to bring us onto an electrified road network. Hydrogen clearly has a massive role to play as well for larger vehicles, where a fuel cell of a sufficient scale can be used. But I think if the question is, are we doing it? The answer is we're not doing it fast enough. And I think you asked who's going to pay for it. The answer to that is fundamentally, the taxpayer will pay for it. We've seen subsidies in the UK being successful across various different asset types in the last 5 years, across wind and solar. We now have a very mature solar investment and wind investment universe here in the UK compared with some of our developed market cohort. I think that what we might see is COP26 might be the starting gun on a CFD structure, subsidy structure for hydrogen. That's something that we've seen the UK lagging behind in compared to some of our other peers. One thing that we should mention when we talk about subsidies is that everyone always thinks of them as a dirty word, but we need to remember that we've been subsidizing fossil fuels in the UK and in developed markets for decades, whether it's defense or whether it's transportation or security. So we just have to recharacterize how we're spending from a government perspective and how that spending is passed on to us.
Yeah, I do think that's a really interesting point and something that we often miss, because it'd be great to build up if you like, a green industry in the same way we used to. We built up such a good oil industry in the North Sea. Where are you seeing the sort of most opportunities though? Let's forget about the sort of the threats, obviously the difficulties for a moment. But from an investment point of view, obviously the obvious one is the renewable energy, but there's all that infrastructure around it, as you hinted at.
Yeah.
Is that the opportunity? Is it sometimes the things that are slightly, shall we say, further down the supply chain, or not necessarily the thing that's right in the centerpiece?
There are several really compelling investment opportunities in this theme. One is that as costs for renewable technology goes down, we are also seeing new regions becoming economically viable for renewable and intermittent sources. So much of America is now, it's actually cheaper to generate solar than it is to use any other fuel source. So that's a hugely compelling investment opportunity for those that understand where that's likely to become the case next. I think energy efficiency is also a really interesting theme that we look to explore within our portfolios. Not only are you using green energy, but are you able to use less energy? So across your business, whatever business you have, can you implement solutions that mean that you recycle heat to use energy or something like that? So there are lots and lots of businesses that are innovating within the infrastructure sector, both in terms of generation, but also in terms of efficiency and storage. And we see opportunities across the spectrum.
Okay, that's really, really interesting. So, Gervase, coming to you, obviously, climate change is a big risk for us all, but it's also a risk for companies who don't adapt, isn't it? We've got certainly from a legislative point of view, we'll have probably some taxation maybe on carbon, etc. So, how do you address that with companies that you invest in, and also other opportunities for companies to benefit as well?
Yeah, I mean, clearly it's a very live issue. It's been an issue where there's been a lot of change in the investment world, even in the last 3 or 5 years, and clearly there's a lot more change to come. But coming back to the actual basics, which is that all businesses are going to need to change, and whilst sustainable funds are good in a way because you invest in companies which are already developed technologies such as wind turbines, which are going to benefit from all of this. What we've really got to deal with is the steel column on which those turbines stand. 800 tons of steel emits an awful lot of CO2, and it's no use just buying the turbine without thinking about the actual sort of column. So from that point of view, what's interesting is I think as an agenda item, it's not just about, companies which are already aligned. It's about the companies which are due to align and how they're going to do that. How do you reduce the amount of carbon you produced when you're producing steel? And that's a huge amount of investment, ultimately. And that's actually where the financial world, I think the financial world has a big responsibility in this, not just the companies themselves, but actually, one of the things about the financial world is we can write checks and we can make a difference in that regard. And that's going to be a big thing. If you overlay that with actually the UK heritage, which is that we've had a long heritage of engaging with companies on corporate governance since the Cadbury report in 1992, clearly this has been a way of managing risks with corporates and helping to reduce risks, which is obviously important in terms of health and safety and all the other areas. But actually, in a way, I perceive the climate change agenda to be another risk. And you could get consumers changing their behavior very quickly. And those who are slow to adapt, as you suggest, might lose market share considerably. Those who are quick to adapt can be... and in fact, if anything, I think the UK fund management sector is ahead of the world in this area. I think we are really good at engaging with companies. We've all got the structures in place, and we have been engaging, like others in the fund management sector, and asking companies, one, to identify their carbon emissions, and then how they're going to reduce them and how they're going to reduce them substantially. And some companies actually do perceive commercial advantage, to them maybe ahead of others. I was just looking a couple of weeks ago at a company called Galliford. It's a fairly well-established, long heritage company. It's a construction business, but they've given a commitment recently in writing and as part of their sort of shareholder presentation that they will get to carbon zero by 2030. Now, what's interesting about it is that they perceive that many of their customers who are public entities of one kind or another will be probably attracted by that and give them more business as a result of that. So I think it's a really big change. I think as a fund management sector, yes, of course, sustainable funds will be part of it, but actually I think UK fund managed funds will probably move ahead of the agenda in terms of the US or Asia. And in that regard, I think actually to bring more investment into the UK, and I think that's going to be a feature. So I'm really quite excited about the agenda, one, because it's the right thing to do, but two, because actually we might actually have a commercial advantage in it as well.
Yeah, absolutely. I think, ESG, as we call it, environmental, social and governance factors, it's not a niche thing anymore. Everybody needs to be doing it. It applies to mainstream investments, mainstream funds, mainly because the risks, I think, to investors of not engaging are huge, and obviously the opportunities are there as well. But just one as an interesting kind of point on that. So you talked a lot about engagement, and I think there's quite a debate going on about how is the best way to change company behavior. Do you let's take the oil and gas giants, for example. Do you divest from them and say you're polluting too much, we won't invest? Or do you keep your investment but engage and try and make sure that they redirect their investment into, say, renewables? Because don't we need that capital in order to get to that net zero?
Absolutely. I mean, I think the energy sector is a really interesting one because clearly, in 50 years' time, we can say that we're all going to have lots of windmills and all sorts of other ways of generating energy without carbon emissions. And at the moment, we've got very little. We have got some, but it's a very small percentage. And there's a real danger that actually we turn off the current energy sources rather quicker than we get the new energy sources coming on. And there's an energy shortfall. I've got to say, I'm really worried by that as a feature. It's not just so much that oil companies have stopped investing, over the last few years because of worries about the climate change agenda and being tarred with a brush that they're polluters. But actually, even back as recent as 2014, with the collapse of oil price after China hit a sort of blank spot, actually that led to substantial investment reduction. And then, of course, more recently with the pandemic, that's led to further reductions in energy spend. So actually, energy spend has fallen catastrophically, really. Don't get me wrong, I'm here, we need to get rid of the carbon, we need to get beyond the carbon, but we need the energy to get beyond the carbon. We need to build the windmills and other things which we need. So I think there's a real danger that we've actually kind of overly so coming back to it, yes, we engage with companies. What we say to them is, tell us how much carbon you're emitting to drill the holes, and drilling a hole offshore takes an awful lot of carbon compared with drilling an oil well onshore. Drilling a sort of gas well is lower cost often than oil wells. On top of that, if you can extend the life of assets, it's another feature where you actually, the carbon's already been spent on drilling the hole, but if you can get it a bit longer. So those are the kind of discussions. And then we're saying to companies, talk about how you're making a difference, and extending lives and such like means lives of wells means that actually you can get actually very good green credentials as a result of that. So we think it's a really interesting topic. We don't think any of these things should be off limit. We should be engaging with all kinds of companies, and we can make a real difference on that bang.
Yeah, just quickly, Nick, just coming back to that point, because it's talking about that kind of, do you agree with that point about, we need to be careful about how we transition to new greener energy? And also, does that has an impact on the grid as well? Surely that we need to have a much smarter grid in order to manage the energy at different times of day, for example.
Absolutely, we need a huge amount of grid infrastructure to deal with the intermittency of renewables and of non-carbon energy sources. Just going back to the engagement point, I think what's really important from a fund management perspective is really understanding the true motivation of taking a position. It's too easy to say, I'm invested in this company that does something that society doesn't like or that is damaging to society because we're trying to change them. But actually, it's convenient to be invested from a financial perspective, and you're not trying that hard to change them. So I think there needs to be real alignment in terms of terminology and in terms of motivation, in terms of why you're invested in these companies. I know you're making a tangible effort to make a difference.
Yeah, I think that's interesting, and I also think as this matures, this subject, hopefully we'll get a little bit more consensus, shall we say, around the financial world about what good looks like. How do we engage? Try and work together better to sort of ensure those outcomes. I think that's really important. Okay, we could talk about that all day. I think it's such a big topic, but I do want to come on to something else equally important, which is the return of inflation. As we come out of the pandemic, we are seeing higher levels of inflation at the moment. So I want to discuss how much of that is what we call base effects. So prices were just depressed last year. They're bouncing back to normal, shall we say. It's just that a temporary effect. And how much is due to temporary bottlenecks, perhaps, as supply as the economies reopen? Or is all this stimulus going to lead to persistent inflation? So Gervase, perhaps for you to begin with, do you buy into the inflation is back narrative?
Well, I just want to wind back a little bit and just talk a little bit about where we've come from before we talk about whether inflation. The key issue in the last 30 years has been globalization, which has been the surge of low-cost goods, effectively deflation imported, inflation locally, net effect, no inflation. And that's been the big surprise for us all in the last 30 years, is inflation has been benign. And the great advantage of that is that whenever we've had a blank spot, then Bank of England have been able to inject extra stimulus. Demand for extra credit means that credit valuation of bonds has gone up and yields gone down, and equities have gone up, and it's all been marvelous, and people are made out like bandits, and it's been wonderful. But it's all been related to that fact that we've had that surge of imports, which has been deflating. One of the unfortunate effects of COVID is, one, that we've actually added huge amounts of extra stimulus, gazillions compared with billions or trillions or whatever we used to do. So on that side of things have gone up. But actually, under the bonnet, when you look back at COVID, and we're not through COVID yet, you can see that actually it has had a big effect on certain areas of supply. So actually, the nightmare is that we've got a supply shortage, not that we haven't got enough demand. And if that is the case, then suddenly governments are in a nightmare of a position. You see companies going bust because they can't make ends meet, and that they aren't able to deliver product. And you can definitely add stimulus, but all that adds is more demand and makes inflation worse. So suddenly we've got a position where actually central bank interaction suddenly becomes not helpful. In fact, if anything, you've got to pull back the stimulus, and actually, unfortunately, that will equal companies potentially going bust. So from that point of view, this is a really, really uncomfortable kind of period to be in. Now, what's interesting from our point of view is actually for the last 30 years, actually, you would have been much better off buying long duration assets. What I mean by that is long dated bonds, for example. If you bought a 30 or 60 year bond 30 years ago, you would have made out like a complete bandit. Short duration assets, 1 year bonds, you wouldn't have suffered much capital loss, but you would have made much less return. But we perceive that that's going to come to a change, and going forward, if you bought a long bond now, you can only be certain that over 30 years you won't make any money. And actually, if inflation takes off, you could lose a lot of money in the next 10 years before you go back to zero again. So from that point of view, we see the whole pattern of the market radically changing, and all of that pattern to do with unicorns and technology stocks and the rest of it is all going to come to an end in our view. And actually, short duration assets, these are income shares, are going to outperform. So from our point of view, the UK has a heritage of income shares, which is great. The UK has underperformed for 30 years. We think it'll be one of the best performing markets going forward, and we think actually the US will underperform. So this is a real kind of, on top of that, we see that the UK has a sort of real vibrancy of smallness. And if global growth is going to be more patchy and there's going to be inflation and other worries going forward, then actually that smallness, what you think is good. So what we're really saying is the UK economy itself doesn't have any advantages. But if inflation does become more persistent, then we think that UK equities will become one of the best performing assets in the world.
So just as sort of summarize and make sure I got this right. So you think central banks will have to respond, certainly cut back quantitative easing, perhaps put up interest rates, and that's obviously not so good for certain types of equities, certainly not so good for bonds.
Yeah, I think unfortunately, whilst they might want to do that, every time they get a bit of a worry, they'll go back to the previous policies. In other words, they'll suddenly put more QE on because they just don't want companies going bust, and none of us do. It's unemployment, it's very uncomfortable, and the rest of it. But all they do is make matter worse. So I think they find it very, very hard to have a hands-off policy, having had a hands-on policy for the last 30 years.
Very interesting. So yeah, we've got a supply issue, not demand issue. So maybe pulling the wrong levers there. Okay, Nick, coming over to you. So if we did see that inflation be a bit more persistent, what effect does that have on real assets? Because surely one of the things that's great about things like property, things like infrastructure as well, is that they do have some sort of natural inflation protection built in.
Yes, absolutely. So it depends on the contract structure that is in place with the infrastructure asset. And indeed, when you're looking at an infrastructure investment, the contract that you're appraising is the most important part of your diligence, because you're looking at how long am I going to get paid for, by who, and what are the terms of that payment. When we're investing in infrastructure assets, we're looking for multi-decade cash flows from governments in most cases, where there is a mechanical form of inflation linkage embedded within that contract. So let's take the super sewer here in London, Thames Tideway Tunnel. That particular asset is owned by one of the companies, or part of it is owned by one of the companies in our portfolio, and they are paid for the next 90 plus years a fixed amount that is rising annually with inflation. So from a revenue perspective, relative insulation from inflation going up, because they're protected. Now, on the other hand, when you've got infrastructure assets that require, or infrastructure businesses that require, raw materials and spend, infrastructure does often require a fair amount of, input spend. That can be subject to negative inflationary pressure. But we're looking for operational assets in most cases, and the inflation upside is present.
So on the other hand, though, of course, if Gervais is right, and perhaps central banks, whether they get the actual tools right, but if they end up being forced to put up interest rates, that's kind of tends to be difficult, certainly for for property investors, and perhaps more for as we say, infrastructure is a long duration asset. It's not a bond, but it's it's certainly over time. So can that be a bit of an issue?
I mean, rising rates are bad for long duration assets. That's full stop. There are mitigating factors with the types of real assets that we look for, which is that if we're seeing rapidly rising rates as a response to inflation, then yes, the long end of your valuation is going to be worth less today if you're doing a discounted cash flow, but you're receiving higher levels of revenue that will partially offset that. So yes, we see it as a risk in our sort of pros and cons analysis, but it's not one that's unmitigated, and it's one that we can certainly manage.
Very interesting, thank you. Okay, so on to our final topic, which is aging populations and the future of healthcare. Gervais, actually, you basically mentioned demographics before, the kind of globalization. A lot of that was about the fact that we've now got, a lot more, Chinese workers, for example, entering the global marketplace. But Britain, like many developed countries, has got very much of an aging population. The proportion of retired people to workers is likely to carry on increasing. And one of the things that that will be interesting to talk about, what effect that might have on growth going forward and on inflation. But also, as we get older, the proportion we have to spend on things like healthcare tends to increase. And a lot of people think perhaps the pandemic has exposed some flaws in our health and social care infrastructure, shall we say, which maybe we shouldn't go into in too much detail. But, if we take that on as read, how do we, if we're going to have to increase more spending on healthcare, how do we pay for it again? And does that throw up investment opportunities? And Gervais, I'll come back to you to begin with, because you mentioned globalization before. You've written several books, and I think one of the themes of those books generally is that you think growth is likely to remain lower for longer. And right. Is that partly driven by that demographic trend?
Yes, demographics ultimately are related to growth, and if you have less people, obviously it's harder. Either they have to become more productive, or you get less growth. So as an actual pattern, and you mentioned China. China's had a surge of employment, but they are quite a society which is aging now, and there's not that many people coming through because of the one-child policy, and they're retiring, and so from that point of view, that pattern we got used to isn't going to be there. The surge of low-cost goods may not be there, and that's one of the reasons perhaps inflation is coming to an end. Inflation is beginning to take off. So that's the first point. Absolutely, we need to be very worried about that. The nightmare is that if we do find that actually inflation becomes a bit more endemic, and I know I'm going to talk about aging, then of course it means the cost of long-term loans starts to go up. And one of the features, which has been a fantastic help to governments for the last 30 years, is that the cost of long-term debt has come down and down and down. And that's put them in a very good position to continue to invest in the health service and all the other things which they put money into for the last 30 years. And if anything, it's been a relatively easy period to balance books. Not easy, but relatively easy. If we suddenly find that actually the cost of long-term debt starts to go up, and that when you roll over debt, you come out of low-cost debt into slightly more expensive debt, then the proportion of their tax revenue going to pay for debt starts to go up, especially given that the absolute level of debt's gone up considerably in the last few years. So from that point of view, suddenly they're in a position where they can't invest even as much as they are at the moment. So despite the fact we have a UK aging population and we need more capital to be invested in NHS and other areas, the government might be in a position where they can't actually even afford it. Add to that labour costs, and if anything, labour has actually been an area where the bottom end of the labour market hasn't really. It's not been. We've been able to bring in lots of people from overseas and all the rest of it. It's been not as competitive. If our wages start to increase beyond inflation, which I think is also a risk, then actually, the government's a big employer, and suddenly that's a big issue for them too. So we're looking at really a pretty nasty, tight period. If that happens, these are all ifs. We don't know. We'll tell you afterwards. But most particularly. This is looking to be a real dilemma, because as we age, we're going to find it really difficult to pay the bills.
Yeah, that's really interesting. So from an investment point of view, though, does that mean, those innovative companies that do come up with a healthcare solution, perhaps are they good places to look at the moment, or does that fall under the kind of the technology bracket? We've talked about some of the dangers of those assets occasionally.
Yes, I mean, when I meet technology companies in the healthcare sector, what I'm always surprised by is how much they charge. it tends to be really, really expensive. And I of course, how can you put a price on our life, and you're saving people's lives, and it's fantastic from that point of view. But the cost of healthcare, and especially of some of the treatments, has been very, very elevated. And unfortunately, I just don't think we're in a position to help companies, for many of those companies to continue to be adopted. So from that point of view, I think it's going to get harder for people to actually make ends meet. But going on from that, I think the main issue is actually we need to become more productive. And actually, one of the features of the last 30 years, particularly in the last since 2007, is that productivity has been stagnating, and QE distorts market prices, and we've had misallocated capital and all the rest of it. What's been the feature of the last 30 years is bigness. We've all got bigger and bigger, and the unit costs have gone down, and long-term supply routes and all the rest of it, they'll all be marvelous. But going forward, we need more smallness. Actually, beyond globalization, we will relearn the value of smallness. We don't get rid of bigness, we just have bigness and smallness. And the UK is sensationally, in stock market terms, a market leader in this area. Not so much that we've got companies of 2 or 3 billion, but we've got a lot of 500 million pound companies and 50 million pound companies. And going forward, in my view, they generate productivity, they generate domestic growth because they use local suppliers, and they pay tax locally. Going forward, that's going to be a sensational benefit for the UK versus other international economies.
It's really interesting. So Nick, coming over to you, I know one of the themes that you play in your real estate funds is healthcare. What do we mean by healthcare assets in a property sense, and do you see an opportunity there?
Yes, well, healthcare really spans both our property and our infrastructure funds, and I mean the division there largely comes down to contract structure and counterparty. So is it the government or is it a corporate that's ultimately paying the bills? But we're looking to access facilities and assets that are part of the physical healthcare landscape. So in the UK, that could be GP surgeries, it could be hospitals, it could be pharmacies. These are all real physical assets where healthcare is delivered to society. These are places where critical services for daily living are provided. And the ultimate counterparty for those services is the NHS in many cases. So you've got a government counterparty for real physical assets, in many cases, multi-decade in nature. That for us is a really compelling investment opportunity, especially when you're talking about getting yields off these assets of 4, 5, 6%. Compare that to some of the longer duration bonds that we talked about earlier, and how little you could get in terms of those returns. In the US, we're also seeing private hospitals, acute medical facilities, but also parts of the US government healthcare infrastructure. One of our investments is a company called Easterly Government Properties, and that owns medical facilities leased to the federal government in the US. It's very different to the medical tech assets that you might find in a more equity-focused fund, but there's definitely a healthcare division in our property and in our infrastructure facilities because it plays such a major role in our lives.
Okay, that's really interesting. Now, listen, I think we could continue some of this conversation all day. There's some really deep subjects we've got into there, but we did say we would throw things open to questions from the viewers. So hopefully I should be joined by my colleague, Ben Rogers there. Ben, have we had any questions coming in?
Hi, Mike. Hi, Gervase and Nick. Firstly, we've had some great questions come in, but just before we start with that, thank you on behalf of everyone watching. It's been a really interesting discussion and to hear both your viewpoints. The first question we've got has come from Jim, and probably best directed at Nick initially. How do you think the UK and other Western economies are performing in the clean energy race when compared to the East and countries such as China?
It's a great question, and clearly there is really a race being run here. You've got on the one side you've got Western Europe, and you've got the US and Canada. They're quite far down the track of renewable energy investment and technology, but then you've got India and China. And if you look at the amount of capacity that's being brought online every year, those two countries dwarf the rest of the world. So I think that it takes a very different type of investor to invest into local businesses within those economies. And indeed, we in our funds don't have many investments in India and China, but we're aware of the landscape, and we think that the future is certainly going to be developing economies moving on to renewable sources, because as Gervase said, even in developed economies, we have pretty limited renewable generation at the moment. Most of the emissions are made elsewhere, so it's going to require a serious investment from places like India, China, and the rest of Asia together.
Just on that topic, because China in particular is very big on solar, and I think I read a stat that the sort of if you buy a solar panel, it's almost impossible to get one that hasn't got some Chinese components. But there's obviously a lot of coverage about the potential for being some forced or coerced labour in that supply chain from we know about the Uyghur labor, etc. So is that a risk? That's something you have to be very aware of when you're looking at some of this investment.
Absolutely, you need to have insight into the supply chain of where the panels are coming from. But I mean, that's true across all industries, not just infrastructure and not just solar. But it is well known that there are components within solar modules that have been built in the regions of China where there are questionable labor practices. I think there is a distinction between pre-2016 and post-2016 where the Chinese government made a bit of a clampdown. So I think there is insight that you can gain from understanding the supply chain, and then it becomes a responsibility really of the investor to make the right decision based on the information that they can find.
That's great. Gervase, any thoughts on that?
Yeah, I mean, I think it's interesting really because I think all corporates have a responsibility to get down to this, and I mean all sorts of corporates. And if you take some of the clothing importers and such like, they get caught out by a big splash in the sun that bad labour practices and the rest of it. And I don't think actually you can't blame the sun. Basically, companies should be doing that. And the way that the Sun gets, or not Sun, but the newspapers generally get their news stories, they have shadow employees. They put them in there, and after a week they know. So it's no use going around with clipboards. You actually have to have shadow employees in all of these businesses to see what's really going on in your supply base. And I think that's a responsibility of PLCs, and it can make a big difference because you can suddenly lose your customer base on the back of it. One event. If
that's a factory in Leicester, that's much easier than if it's a factory in China, I suppose.
But I'm afraid, if you're going to import from China, you need to know too.
Absolutely, we're going to have to all be looking at the detail. So I know we will be short on time. So Ben, have we got some more questions coming in?
Yeah, brilliant. We've got a bit of a flurry, so I'm going to try and combine a few. So do bear with me for our viewers as well. Gervase, you mentioned that the UK equities in the UK could, that you think they look good going forwards, particularly the smallers. After being hit hard by the pandemic and lockdowns, how do you feel that Brexit may impact on companies both in the UK and, if you're happy to comment as well, in Europe?
Yeah, I mean, it's interesting, really. I mean, Brexit has been an issue. It's actually held back investment. Typically, people have been able to make good money in other international markets, particularly the US. NASDAQ's been fantastic the last 5 years when Brexit's been on and the uncertainties. So it's really led to an underinvestment in the UK and many international investments. So actually, we've come out of the end of Brexit with a period where most people are not as weighted in the UK as they were previously. So there's a lot of catching up to do from that point of view. In terms of the businesses themselves, whilst they might be, in many cases, small companies, they're often market leaders in their own industry. They've got manufacturing plants in Europe and US and Asia and all the rest of it. So actually, yes, there's some logistic issues as Nick was talking about, but bottom line is actually they're able to manage those. In terms of the things we worry about, it's near zero.
Nick, any comments? Any Brexit effect on the assets you invest in?
No, very limited. Operational physical assets located in one place or another. It's not something that we've really seen a huge amount of impact on, apart from, as Gervase said, some of the underinvestment in the economy as a whole.
Yeah, great. Okay, Ben, have we got any more questions?
We have a question here from Keith. When you say that you see opportunities in the healthcare sector, how do you ensure that you are not taking profits away from much needed resources in the NHS?
So I think that's one for you, Nick.
Yeah, and I think we have to look at the government's infrastructure strategy that they published in the autumn. And I think it's a fact of life that the government, having dealt with the pandemic, does not have the balance sheet to deliver the level of social care and the level of clean energy generation and all of the other imperatives that we have at the moment. So what they have said is a key strategic objective for the future is to incentivize private capital to deliver public infrastructure. Now that means that there will be profits flowing to the private sector. We are not in the business of seeking out egregious profits at the taxpayers' expense. What we're looking to do is find a good investment for a socially relevant asset.
I think it's a really interesting point, Gervais. Maybe whether you've got any comments to add, but I think do we need the private sector to invest as well as the public sector on a lot of these issues we're talking about?
Yeah, I mean, obviously, the problem with being a big employer is sometimes you get all sorts of quite ingrained practices, and it's kind of difficult to change, and people don't want to change, and all that kind of stuff, and it's uncomfortable changing. And so, what you need is different thinking, diverse thinking. You know, you can try different things, and although different hospital trusts try different things, and different GPs try different things, the private sector also tries different things as well. And sometimes they work, and sometimes they don't. And when they do work, they can be there rolled out into more others. The ultimate is about improving productivity, but also making staff working in these environments more engaged, more to have better days. We don't want people to be in the health service and dealing with all sorts of old systems which they can't make work and all that kind of stuff. So it's all got to be demonstrated by productivity improvement and ultimately cash paybacks.
Okay, great. I think we've probably got time for just about one more, I would think. Ben, have you got any others?
Yeah, so this one came from Nigel. Do you feel, or does the panel feel, that there has been a desire to onshore and have more control in the UK of more strategic industries? So things like tech, steel, medical and pharma, which we've spoken a bit about there. And if so, what do you feel the impact of these industries would have on the UK economy?
Gervais, that's something you were talking. Yeah, so I'll do Gervais and then Nick. So that's something you mentioned earlier.
Yeah, I mean, I think the scale of the change in the political agenda in the last sort of 5 or 8 years has been massive. You know, we've had for the last 30 years a political consensus towards globalization, left and right. And what's happened more recently is that QE's distorted market prices. It's been in place since 2007, effectively, and therefore mispriced assets have meant misallocated capital. Productivity is flat around the world, and the reason why that's such a big issue is because wage growth has been disappointing. So nearly all of the electorate haven't had decent wage rises for the last 15 years, and that's what's led to this massive flux in the electorate, where they are now happy to vote against where they voted for the last 30 years. And so you get, in the north of England with the 2019 election, a lot of people who had voted Labour their entire lives voted Conservative, and what we saw recently with the by-election down in wherever Amersham, wherever it was actually a whole lot of people who voted Conservative their entire lives suddenly voted Liberal Democrat. We've got a flux in the electorate, which is a worry, because people who are charismatic, who say they've got a great idea, can get voted in, and you can just get a change of political agenda just like that. And it can be a very radical thing, and it can be the wrong decision. Actually, it just sounds good. So actually, I think we're looking at this kind of change coming through very substantially going forward at this stage.
Yeah. Nick, anything to pick up on the kind of globalization agenda? And I think on Gervais's point, perhaps a stable political outlook is always useful when you've got government-related assets, I suppose.
Absolutely. Continuity and grandfathering of contracts and everything's very important for infrastructure. I would just maybe finish by saying that going back to the renewable energy and the climate imperative and building back better, stability is definitely required for that. Stability between regimes and also cooperation across borders. So I hope that that's what we see in the near term.
Yeah, absolutely. But I think we're going to have to wrap things up there, because I know we've got other meetings, etc., to go to. But just on behalf of Equilibrium and everyone listening at home, Nick and Gervais, thank you very, very much. I think that was absolutely fascinating, and I think we could have gone on all day. But thank you so much. For those of you watching after the event, if you did enjoy it, then please do feel free to share that with anybody who may be interested. That would be really appreciated. We will also send out a feedback form after the event, so if you could complete that, again, that would be really helpful, because that always helps us to tailor these events to what people would like to see. It's well worth your while filling in that form, because we will enter everybody who does into a champagne draw. For those of you who are new to Equilibrium, who haven't heard too much about us before, we would love the opportunity to have a chat with you at some point. No strings attached, just to have a chat and see if there's anything we can do to help. we can do that virtually, and if you want a virtual coffee, we'll even send you some coffee, or we can do that in face-to-face hopefully soon as well. So, if you will probably get a phone call from a member of the team just after the event, just to see if there is anything we can do. But thank you to everybody for listening. Thank you to both speakers for joining us. I hope you enjoyed it, and we'll see you again next time. Thanks very much.